Well, hello and welcome to this rainy trading day right here in Lagos, Nigeria. I hope you're still able to make that trade this morning. Here are the top stories you should be looking at now. Let's start off with oil prices now. They remain volatile as investors weigh the prospects of a fragile ceasefire between Iran and Israel after both sides announced a halt to, direct attacks. And we're having that movement again. Starting off this week, we did see, a jump yesterday with oil prices, but now, again, with geopolitical news, we're seeing oil prices down again. The market has surged as much as 5% in the previous session on fears of a supply disruption in the Middle East, particularly around the strategically important Strait of Hormuz. While the pause in hostilities has, eased some of those concerns, analysts say geopolitical risks remain elevated, keeping oil traders on edge and energy markets highly sensitive. But remember, there's supposed to be that inverse relationship between oil prices and the likes of gold. And some of the risk assets, definitely we'll keep our eyes on gold to see how it's impacted by this flip we're seeing right there with oil prices. But definitely we'll be watching all of that. Investors will also be watching to see how these commodities perform this week. And so much attention also on most of the risk assets. All right, to other stories now. We see the import bill for Nigeria has plunged. That's the petrol import bill has plunged as much as 2 trillion naira in a dramatic sign of the country's shifting energy landscape. The MBS shows, data from the MBS shows petrol imports fell by 96%. Year on year to just about 87.4 billion naira the first quarter of 2026, compared with 2.27 trillion in the same period last year. So there you have it. The total imports data comparing 2026 Q1 to Q1 2025, that's 16.64 trillion. So we see a drop there. If you move over to Q4 2025, that was even much higher at 17.25 trillion naira. That's total imports there, petrol imports. So on a year-on-year basis, we're seeing 8.17% decline, quarter-on-quarter, 21.05%. So definitely a good sign there. Other oil product imports, Q1, 748 billion naira. Q1 2025, that's about 5 trillion. So that's an 85% decline already. That's for other oil imports there. So definitely, I guess, good for Nigeria. I guess the refineries are working. Some of the refineries in that sense. All right, let's get a check now. A lot to unpack in the commodities market from the latest OPEC meeting. Oil prices again giving us the up and down movement this week. Joining me now, we have Mr. Bismarck Kurani, CEO of Financial Derivatives Company. Great to have you on the show, sir. Good morning.
Good morning, and thank you for having me.
Fantastic, sir. So we're seeing Brent crude is falling by about 1% this morning after the big jump, we saw to kick off the trading week. So they're saying is, the pause in hostilities between Israel and Iran. Do you see this decline as a, temporary geopolitical reaction, or does it signal a broader easing of risk premiums in the oil markets?
Thank you, Larry. The issue is that let us differentiate between price volatility and price reduction. What we do know is that trying to forecast correctly when the Strait of Hormuz is going to be open and when oil markets are going to return to normal is like catching a falling knife. None of us know, and let us not even attempt to do. But what we do know is that for every $5 movement in the price of oil, Nigeria's export revenues will increase by 5% or 51%. In other words, it will be almost 2.5% increase in our export revenues because of a $5 movement in the price of oil. So when it dropped from $98 to $93, you can actually calculate that. Then Nigeria's export revenues would increase. Export revenues will actually decrease by as much as over $200 million for that period. So, but on the other side, there's a 49%, which is the, and you just alluded to it in your, that petrol imports and all those dropped. So our domestic production and every $5 movement affects our domestic production, which is 49% of our total oil production. So what is the domestic production? Part of it goes to the Dangote refinery, part of it goes to the modular refineries, and part of it, is used for other uses. So basically, we and Nigeria as a country is exposed to those risks of volatility, but also exposed to the extent that the Nigerian government revenue is distinct from the people's price they pay at the pump. In the last 3 days, the Dangote refinery had actually brought down prices. In spite of the fact that international prices were volatile, they took a strategic decision to bring down prices marginally so that Nigerian citizens will not feel the direct impact or the immediate and total impact of this price volatility. So what have we got with, because we are refining domestically and efficiently, we are now insulated somewhat. But we have not seen the benefits, and we are yet to see the benefits of a sharp drop in the price of oil. What do we think? Our view is that because of the World Cup, at least for the next 30 or 40 days, we are going to see the oil price stay relatively stable and lower. We are going to see less hostility in the Strait of Hormuz and in Iran. So one can predict, without any fear of contradiction, that we'll see the price of oil stay maybe at about $90 a barrel. That's Brent. And WTI about $80 a barrel for now. What happens after the World Cup? What happens if Israel becomes kind of intransigent? Then the price is on volatility, but I doubt that that's going to happen. Our view is that the price of oil has probably peaked and now begins to come down gradually. What does that mean for Nigeria? It means that our revenues are much higher than what we forecast in December and January this year. But how are we going to deploy that increased revenue? That is why you see today, or in the last 2-3 months, the Naira has been stable and has appreciated against the basket of currencies in which we trade. So one can say categorically that the price of PMS, the price of diesel, is not likely to increase. If anything, will decline. The value of the Naira is still up 13 or 14% undervalued, which means that the Naira is not likely to depreciate or be devalued significantly.
Right.
Because central bank on top of that. So, and what is the effect of that on prices? I think that has a very, it makes prices, it increases disinflation and reduces the impact of price increases for now.
Okay, well, I guess, at this point, some of us rejoice when we see, oil prices, coming down, but at the same time, that's bad for, government revenue. But let's look at OPEC Plus now. They've had their meeting, that was over the weekend, and they collectively agreed to, raise the oil production by 188,000 barrels per day. That's for July. What does this signal about the group's confidence in global oil demand?
Like every cartel and every oligopoly, it's about who are price leaders and who are price takers. Do not forget, you will recall that UAE exited OPEC, and UAE has about almost 3 million barrels a day. So OPEC's share of total global oil supply is hovering at about almost 30%, which is normal. But as we move along, I think there's a lot of discussion in Nigeria that, what do we get by being in OPEC? It is what do you lose if OPEC falls apart? What you lose if OPEC falls apart is that you have no control over price and you have no control over output. So we get screwed if that happens. So it's in our best interest that OPEC holds together and OPEC Plus holds together, and that there is what we call mutually assured production limits, which means that not everybody suffer. Saudi Arabia needs oil price at about $70, $80 a barrel. We need it as high as possible. But the question that Nigerians are asking that, yes, you said just now that the price of oil increases, good for government revenue. But the price of oil increases is bad for the pockets of Ladi and himself. So we are caught in between. But if the government can deploy its resources efficiently and reduce leakages, then we'll be a win-win. Win for government revenue to fetch to us, and win for us because we are buying less petrol.
Right, and definitely we're hoping that, even if oil prices go up, it's also a win for the people, even though it is mostly for the government.
Yes,
at this time.
I comment. I wanted to make a comment. You know, we expect next week the Federal Reserve to meet. And all eyes on the fact this will be the first meeting chaired by Kevin Walsh. And the whole idea, he said two things. One, he's not too concerned about the interest rate, which we all expect to be kept constant. But he's going to de-emphasize the guidance. You know, normally what happens is that the Fed chairman makes his broadcast and tells people that this is the decision. But the guidance is that we expect this to happen in the next quarter or two. And people take their cue from the guidance. Kevin Walsh says he doesn't think that the Fed is in the best position to be forecasting or giving guidance. So what we're going to see is a rate hold, but very limited guidance for the future. So it means that volatility in markets, in stock markets, asset markets, Bitcoin, stable coins, and all of that, is going to be higher because there's limited guidance for the Federal Reserve. I think that is something that we have to bear in mind. And before we go, I would like to touch on the stock market has been flat and has actually declined over the last week or two. Why is this happening? Is it that, listen to you, Ladi, about this, is it that people are selling stocks to build up a war chest to buy into the IPOs? Because it's not just IPOs. The IPO of the Dangote refinery is one, but you have IPOs of SpaceX. We have IPO of OpenAI today, and we have IPO of Rempic. So when you look at that, it's not only here that very rational investors are making the decisions that buy on the rumor and sell on the news. So everybody is preparing to buy on the rumor and also sell on the news after the IPO is finished. But we've seen situations where post-IPO, we've seen share prices drop after an IPO before it covers. So if you are borrowing to buy into an IPO, you've got to be careful. But if you are, and I'm not talking about IPO in Nigeria, I'm talking about IPO globally. We've seen a lot of international foreign portfolio investors who are going short on stocks and preparing to take advantage of the IPOs. Because all of them want to be like Elon Musk, if it's possible. Not all of them want to be like Warren Buffett, who is conservative and a prudent investor.
Or maybe the asset managers and investors should, source funds from elsewhere instead of selling down on some of the stocks they already own just to get into these IPOs.
No, what they do, they rotate their portfolios. You never know. You never know. Again, like I say, at times it's like trying to catch a falling knife. You'll never know.
All right, there's the IPO frenzy. We'll definitely keep watching out and see how these IPOs perform, post-listing.
Larry, stay tuned. The IPO is going to make money for a lot of people.
Exactly. Right? Yeah, hopefully we can, put some money, in there.
Yes.
Thank you so much, Mr. Bismarck Rani, MD CEO, Financial Derivatives Company. Thank you so much, sir. All right, now let's get a check on how your money performed yesterday. Talking about stocks now, we see Nigerian stocks extended their recovery yesterday as bargain hunting returned to the equities market, adding 514.97 billion naira to investors' wealth. The Nigerian All-Share Index, we see it up about 0.33% yesterday, 242,593 points, with a big sell-off to saw. Last week, taking the index down about 3% for the whole trading week last week. Volume, value, and deals compared to Friday's trade, 746 million, valued at 58.05 billion naira. Oil and gas stocks led sectoral gains while investors continue to monitor whether the latest rally signals a sustained recovery following the recent market correction that wiped out more than 4 trillion naira in market value. Investors will be looking out for that. To all the stories now, Nigeria's consumer protection regulator has intensified its crackdown on real estate sector, sealing the Lagos office of a real estate company. We'll get more on that story after this. But we still have other matters surrounding Nigeria's environment sector. That's talking about water supply now. The nation's urban water sector needs billions in investment, and the federal government said they are turning to development partners to bridge that gap. Speaking at a meeting in Abuja, the Director of Water Supply and Support Services at the Ministry of Water Resources, Mr. Babarinde Mukaila, who represented the minister at the event, explains that although development partners have funded water projects in over 10 states, stronger governance and policy reforms remain key to delivering the needed results. He further stresses that increasing water scarcity combined with financing shortfalls is threatening Nigeria's ability to meet SDG 6 on water and sanitation. Take a listen.
Over the years, government at all levels, with the support of the development partners, invested heavily towards the reform of the urban water supply sector, with marginal national success recorded. The ultimate goal is to have urban water utilities that provide reliable and adequate service that are operationally capable and financially stable. This workshop is apt towards a critical review of our performance. Are we on track? Look inward to see where we need to improve for future project implementation and to showcase good examples and tested innovation to emulate and adopt.
The AMDP believes that the review of the water and sanitation sector in Nigeria will contribute to principles like providing information about the current state of the sector, including sector goals, objectives, strategies, policies, legal and institutional framework.
All right, we'll take a moment now. When we come back, we look at ESG. That's the moment. Just stay with us. All right, our next conversation now, we're focusing on sustainability, climate leadership, and Africa's economic future. At a time when the world is rethinking growth, investment, and resilience, Africa stands at a defining moment. While the continent contributes the least to global carbon emissions, it remains among the most vulnerable to climate shocks, from food insecurity, energy challenges, to rising adaptation costs. Yet within these challenges lies a powerful opportunity for Africa to position itself as a global leader in green innovation, sustainable finance, clean energy, and inclusive economic growth. Well, joining me for this conversation now, we have Dr. Chizo Malize. She's Managing Director, Chief Executive Officer, FITC, and she joins me right here in the studio. It's great to have you on the show, man. Good morning.
Good morning. Good to be here.
And thank you for making it, regardless of the rain, out there. It's a very rainy trading day today. All right, looking at the data now, Africa's share of global emissions, less than 4%. Yet, we get the wrong end of the stick, when it comes to the impact, of that. But definitely this is seen as a disadvantage, for Africa. How can we turn this into an advantage? How do we flip it?
Thank you. Good to be here again. And so Africa has the opportunity to flip all the issues around green evolution to significant success story by making the right investments and having the right strategy for the journey. So we understand clearly that as the world moves to green, and as the world is also looking to greener and sustainable development opportunities, Africa is at the point where we have huge quantum level of human natural resources and mineral resources to develop the continent. And so Africa must therefore, at this time, make investments that are green, investments that allow the opportunity of growth in infrastructure development in areas that are more sustainable. Changing, therefore, the models that we have, for instance, for infrastructure development to models that are led by the Green Revolution. And so smart investments, that means we're attracting capitals in a way that is sustainable, and capitals that can be invested in the areas of renewable energy, green infrastructure, railway systems are changing, but how are we also able to ensure that the climate issues are taken into consideration as we are making investments, say, in social infrastructures? And so we have the opportunity to build from scratch where we have not built, but build in ways that are aligned to the green revolution. And so to make this happen, the models for infrastructure development must change. So we are also therefore having the opportunity of late mover, for instance, which gives you the opportunity to build as aligned to global developments and global expectations. So that sort of opportunity means significant alignment that will therefore attract the right investments, the right funds, the right capital into the continent that is still virgin, so to say.
Right, and talking about, investment and, turning the disadvantage into an advantage for the continent. But we have a continent that, seems to act independently, looking at the countries in Africa. So looking at Nigeria now, what do we do, when it comes to investment and, taking advantage of where we are right now as a country, if we cannot do it together, as a continent? What do you do individually?
So the world has kept Africa very fragmented for a long time. But it's also important that Africa begins to look at itself as a single continent that can work collaboratively with one another. We do know that there are so many platforms driving that, like the African Union. But it's also important that even the collaboration that is envisioned by African Union is also executed by the leaders of these nations. And so collaboration allows the sort of partnerships that can help people co-create, co-invest, co-execute. And so you look at a West Africa that could actually be absolutely seamless in terms of transportation and movement. So when people get together within regions, whether it's Southern Africa, Eastern Africa, and Western Africa, so much can be co-created and so much investments that can also drive scale, especially when each of these countries can come together to make such investments happen. And this also includes policy, because there could also be policies that can catalyze growth, cross-continent growth, cross-regional growth. And so collaboration is the key word for achieving that sort of success.
Right, and definitely ESG, that's been a buzzword, but I don't think it's been that buzzy, this year. Do you think, ESG is becoming a compliance exercise, rather than, boardroom strategy, for most companies?
So many look at their investments in ESG as the need for compliance, especially the need to ensure that reports are right and the reports are made at the right time to avoid sanctions. But the moment that organizations, institutions, and bodies and agencies begin to see ESG, not just as compliance tools, but more importantly, as developmental tools and as tools that will be leveraged to build strategy for their businesses, aligning therefore their ESG practices along the line of their business strategies, then there will be a shift in the way that risks are identified and managed and mitigated as well. A shift also in the investments that are made, the way that they achieve operational efficiencies, the goods and services that the organizations produce, the way that the organizations connect with the society where they function, the sort of investments that are made in the society, to the extent that there's social development and social growth. So compliance is just one thing. At the end, you want to be able to report what you've done, but more importantly is to be passionately doing these things aligned to the business strategy in a manner that is systematic, strategic, and deliver growth. So what will come out of that is that we're going to see institutions and organizations that are stronger, that are aligned to governance, that are aligned to rules, regulations, and truly, therefore, are able to perform optimally. Institutions that identify that their people and their talents are very critical and important and make the right investments to see that they are optimum. Institutions that are aligned to systems and structures and processes that will drive efficiency. And then we can begin to see institutions that truly drive growth. Growth in their business and operations, growth in the society, growth in development, and growth in overall good. And that's just the same way and the best way to therefore drive a prosperous future, both for the organizations, their countries, and for Africa as a whole.
Well, I know you deal with most of these companies, on a daily basis, but do you think ESG investment is top of mind, when it comes to the organizations you speak with?
It is becoming top of mind. One of the reasons it's becoming top of mind is that there are several agencies and organizations that are also demanding that reports are done, that compliance happen. And so each and every one of these agencies require that work is done. And so where there is a gap is in the knowledge and the capacity and the capabilities. And so this is one of the things we do in FITC, because our FITC Sustainability and ESG Institute is designed and equipped to be able to train institutions and their people to be able to create and craft cutting-edge ESG strategies. Not only just the strategies, but also the sort of programs that can help them truly make investments in the right places. The sort of programs that would help them attract capital to their organizations, and more importantly, that would also help them make true impact. Now, reporting is also very critical. You don't do all of these things without a structure for reporting. So we are also able to equip them with the knowledge and the toolkits for reporting all of their actions. So to a large extent, there is growth, and every time it's incremental. And I can assure you, the speak around sustainability and ESG in the last 5 years is on the increase. And that's the reason why we consistently create thought leadership at FITC. So the world can come together from everywhere in the world, online, physical, digital, to learn about these things and then embrace it, because what you do not understand, you may not be able to execute. But by being around the right persons, policymakers, industry leaders, thought leaders, experts, advisors, and all of that, then you would learn more and take such learning back into your organization.
Right. I'm trying to imagine if you had the attention of every CEO and board member, at this point, what 3 decisions would you want them to make, when it comes to ESG?
So the first is to ensure that the ESG strategy is cut clear, it is documented, and it is articulated, but it's also aligned to the business strategy. We have seen where people just go on a tangent. They're interested in environment, they're interested in social, they're interested in governance, but they're actually not executing each well enough. They are simply dissipating resources in a manner that is not aligned to the business strategy or the focus or the goal or the direction they are going. So that's number one. Create ESG strategies that align to your business goals. The second is execute ESG in a manner that allows for collaboration. Find partners who are doing so many other things. Some have built platforms for the expression and investments that you require. Some are actually also there to also help you and guide you to get it right. But more importantly also, there must be collaborations between organizations, government, civil societies, several of the NGO and the not-for-profit companies that have set up to be able to fill the needs, whether around the environment or social, find and make such investments in them and collaborate with them so that the programs, the ideas, the initiatives that you have are excellently run. And that's really what gives impact.
And before I let you go, execution. How do we get execution moving away from, strategy? You've done all your strategy.
And so that's where reporting comes. Reporting allows you to know what's measured, what's important, what indices you should be mindful about. And so execution means that you want to be able to execute in a way that aligns to your strategy and then the ways that you are also able to report. You want to be able to aggregate your activities and investments in a manner that you are also able to report. But the good thing is all of these things we've mentioned here is one of the reasons that FITC we're always bringing these thought leadership programs, like the conference which is coming up soon. And so at the conference, people would learn quite a lot of those things.
All right. All right. So much to unpack there.
Yeah. Speaking about the conference also, so FITC is coming up with this, like we do all the time, the Sustainability and ESG Conference, which comes up soon. And we do expect that these thought leaders, these CEOs, these decision makers, and these chairmen would not only be in the room, but also engage with the other people who are playing in this game. And at the conference, you would learn every single thing you need to know about sustainability and ESG.
Sustainability.
Yes, and ESG.
Yeah, very important right now for every business. Thank you so much, Dr. Chizo Malize, Managing Director, Chief Executive Officer, FITC. Thanks for coming on the show today.
Thank you. Thank you for having me.
All right. So now we see Nigeria's Consumer Protection Regulator. They've intensified crackdown on real estate sector, sealing the Lagos office of one of the top real estate companies in Nigeria, allegations of non-compliance with regulatory directive. The FCCPC says the action follows unresolved complaints from subscribers. Take a listen.
Unexpected visitors at the premises of P1 Max Property and Business Solutions Limited in Lagos. Officers of the Federal Competition and Consumer Protection Commission, FCCPC, say they are here at the premises following a complaint by a consumer on the non-allocation of 20 plots of land fully subscribed to and paid for in February 2025. But even before they really commence, there's a notice on the gate to visitors of P1 that the office is closed as members are off for a week of prayer and fasting. The team moves into the offices in spite of this and meets just one security personnel who says the executive and officers are unavailable. Attempts to forcefully access the office is unsuccessful, and so the offices and its subsidiaries are sealed.
That's what I'm saying. Put it on the wall. It's still the same. Let's put it on the wall. Sorry.
Despite being duly served with the compliance notice and given a reasonable period to take the required remedial step, this undertaking has failed to comply with the notice. Consequently, an indirect exercise of FCCPC power under Section 150 of the FCCPA 2018, which says that where an undertaking failed to comply with a compliance notice, the Commission shall shut down or close any premises from which the notice continues to be breached until the breach or non-compliance is remedied.
And just when the FCCPC thought it was over, an individual who claims to be a victim approaches them.
They say they want to give me a land, a plot. So now I paid them small thing, I paid the money finish. Up till now, I did not see them, I did not see the land. But the day they first of all take me to the allocation at Edagote Rivanary, is the only that day that I see them. Then now, when I paid finish everything, I didn't see them again.
The government warns members of the public to do due diligence before engaging in any form of investment.
All right, now let's look at the future of business financing in Africa. For years, much of the global narrative around African entrepreneurship centered on venture capital, billion-dollar valuations and high-growth technology startups. But today, the conversation is evolving across the continent. Investors and business leaders are increasingly recognizing the importance of financing, what many call the real economy. Businesses operating in critical sectors like agriculture, energy, manufacturing, mobility, logistics, and essential services. These are the companies solving structural problems, creating jobs at scale, strengthening supply chains, and driving long-term economic transformation across Africa. At the same time, we're seeing a major shift in how these businesses are funded. Debt financing, catalytic capital, blended finance, and local currency investments are becoming increasingly important as founders seek sustainable growth without excessive dilution. Well, joining me for this conversation now, we have Oyin Sholebo, the CEO of Cascador, joining me via Zoom. Great to have you on the show. Good morning.
Good morning, Adi. Thank you for having me.
So for years now, venture capital, that dominated conversations around, African startups. Why are we now seeing a growing shift towards alternative financing models like, debt, catalytic capital?
Thank you so much for the question. And you summed it up absolutely correctly. So we saw, for example, last year, 1.6 billion in debt funding coming into Africa's startup ecosystem, and it accounted for about 40% of capital. And in the first quarter of this year, we've seen something incredible happen where debt funding has actually overtaken equity funding. Now, to understand, I guess, why that has happened, we have to step back a little bit and take a look at what's happened in the recent years. So in 2022, as you've covered a number of times, we saw this uptick in in equity and venture capital coming into the ecosystem because of global low interest rates and investors really looking for a return. But then off the back of geopolitical crisis, we saw global interest rates increase and we saw a lot of investors leave the ecosystem. But companies still need to be funded. So one of the first things that happened is that debt stepped in to fill that gap. But what's interesting is that it was not a crisis move. What we actually saw was that the companies that they were funding were credible companies, mature companies, companies with real revenue, real assets, real customers, companies like Move and Max and M-Copper, who really had earned their stripes and earned the ability to repay debt funding. We then also saw a change in the sources of the capital. So a lot of the big venture funds who are used to investing equity left the ecosystem. And in their place, we saw DFIs, so development finance institutions, or sovereign-linked banks come in and deploy more capital. And these are institutions that are more used to debt funding and therefore structurally more enabled to provide debt funding. And then as all of that was happening, I think we also saw founders ask themselves, do I need to continue pushing for equity funding, or is there something else on offer to me? And what we saw with companies that had been resilient and done well to really succeed through the 2023-2024 funding crisis, who are now more sustainable, more capital efficient, more focused on unit economics, they were able to ask themselves, why should I give up a part of my company through equity funding if I can actually sustain debt funding? So all of these things, I think, have contributed to what we have now seen, where in the first quarter of this year, debt funding actually overtook equity funding.
Right, and it was mostly about, equity funding, before now, but some have argued, for stronger support for, the real economy ventures. What exactly defines a real economy business, in the African context?
Absolutely, and Laddie, I think you summed it up actually really well before I came on. So when we're talking real economy businesses, we are talking businesses that are producing or moving or enabling tangible goods and services that people actually need in their day-to-day lives. So we are thinking agriculture, food processing, energy, healthcare, manufacturing, logistics. These are things that we can really touch and feel. And that is versus perhaps the digital economy, where we're thinking apps, digital infrastructure, marketplaces. Now, both of these have enormous value, but as you quite rightly said, I think it really is in this real economy where products and services are being provided that people need in their day-to-day lives. And regardless of whether or not we have upticks or downticks in the economy, people will still go out and buy these products and services.
All right, so definitely debt financing, that's gaining momentum across the continent. But, when you take a debt, when you take loans, you definitely have to pay back. Do you think some of these founders, do you think debt is what they need right now, seeing that cost of borrowing is really expensive?
Yeah, it's a great question. So I think we have to look at what stage the company is at and then make sure that the type of instrument that they're getting is appropriate. So if you were an early stage company where you were still proving that a customer is able to sustainably pay for your product or service and that your unit economics make sense, that really is where equity should be playing a part. Equity is built to take on that kind of risk. Debt funding is not for that kind of business because, as you said, there is an interest rate that they need to pay, particularly if it's commercial debt funding, so funding from a bank. A very early stage company may not be equipped to pay that back. In fact, it will put an unnecessary pressure on that company. So I think we really need to look at the stage of the company. But what we are seeing at the moment is that companies are maturing. So again, if we look at the kind of the companies that have gotten the debt funding in recent years, these are companies that have been around for many years, that have shown that they have sustainable revenues, that have shown that they have healthy cash flows, and they have demonstrated that they are able to pay back that debt. That may not be the same situation for a very early stage company where equity really plays a very important role.
Right, and definitely I know you investing, most of these companies. Where are you stashing cash now?
Stashing cash. So I work for a company called Cascada. I'm the COO there. And at Cascada, we specifically invest in companies who are approaching that growth stage. So these are companies that have proven that they have real revenues, real customers, etc. But probably they are too big for early stage funding, grant funding. And the risk may be perceived as too high for them to get that commercial funding. But these are companies that are filling a really, really important role. They are in that messy middle where they really need the support to get to that growth stage where they can afford growth capital, commercial capital. That is where I'm investing. I think these companies are incredibly important because they are the companies that tomorrow will continue to provide us with the essential products and services that we need. But they are also the companies that tomorrow will be employing massive amounts of people, and particularly, if we talk about the real economy, people in rural areas, low-income communities, young people who may not be as educated as they otherwise would be, and employing these individuals and providing thriving employment opportunities for them. All of that ripples down into the health of our economy. If you think about it, we have, for example, recently invested in an agriculture company called Agriark. We deployed 2.5 billion naira into that company. That company is helping local and global food processors reliably source commodities from Nigeria and beyond. Now, that is a company that is not only providing essential produce to Nigeria and also to the world, but it is also a company that, through its scale, is able to employ and give decent incomes to everybody that it touches. So those are the kind of companies that I'm stashing my cash into. It's really companies that are approaching the growth stage who, through getting that, that leg up, they can, in the future, afford more commercial capital.
Right, and I'm happy you mentioned Naira, there for that money you're investing there, because I'm seeing most of the founders now, they're looking to take some of that debt in Naira and not, foreign currency, because of the risk there. Thank you so much for joining us this morning. Oyi Sholebo is the COO of Cascada. Thank you so much for coming on today.
Thank you for having me.
All right, we'll take a moment now. When we come back, we'll see what's happening in the global economy.
Good morning, everyone around the world. It's a wet Wednesday here, a wet Tuesday here in Lagos, Nigeria, but that doesn't stop us from giving you the global news. And we're starting first on the AI side of things, where we are talking about OpenAI. That's the maker of ChatGPT, which has filed confidentially for an IPO, joining the artificial intelligence rivals such as we'll be having later this week. We'll be having SpaceX, as well as Google's parent company, Alphabet. So they're joining the likes of these two giants, AI giants, tech giants, to tap into public markets to fund their ambitious growth plans. Now, the Sam Altman-led firm submitted paperwork for an initial public offering with the U.S. Securities and Exchange Commission. So now the company says, made that statement just a couple of hours ago. Now, OpenAI is working with Goldman Sachs Group Incorporated and Morgan Stanley on a potential listing as soon as the fall, as soon as that's sometime later next month or so. So that's according to people who are familiar with the matter. So the tech, let's move over to another tech story. So U.S. tech giant Apple says it is expanding its safety features as governments around the world expand their move to restrict young people, particularly teenagers, their access to social media. Not quite long ago, we had Facebook, as well as some other tech companies, saying that they're restricting the access of teenagers into social media and so many other features just for child protection. So now the company says it is introducing stronger parental controls, enhanced content filtering, stricter communication permission, and an updated screen time tools for its products such as iPhones, iPads, and Mac computers. Now, Apple concludes by saying that the changes are designed to give their families more control over their children's online experience as countries including Australia push ahead with tougher social media rules for minors. Now let's move over to Germany, where official figures says the German exports posted stronger than expected growth, buoyed by increased demand from key trading partners. However, the positive trade data was tempered by weaker than forecast industrial production, suggesting that the country's manufacturing sector continues to face headwinds. Now, the mixed economic indicators highlight the uneven pace of Germany's recovery as policymakers and investors monitor the outlook for Europe's largest economy. Now let's move over to China, which is preparing to spend around 2 trillion yuan, that's about $295 billion over the next 5 years on building data centers across the country. And that's fueling Beijing's ambition to propel the domestic AI sector and surpass the US in a potentially game-changing technology. Now, key government agencies, including the National Development and Reform Commissions, are drafting a blueprint to erect a network of interconnected computing hubs across the country. Now, state firms such as China Mobile Limited and China Telecom Corporation will operate the bulk of the data centers and ensure that they're connected. Now, let's move over to Switzerland, where shares in Swiss bank UBS are gaining after reports that lawmakers in the country are considering a softer approach to proposed capital rules for the banking giant. Under the current government plans, UBS will be required to fully back its foreign subsidiaries with top-tier capital, a move that the bank says would significantly increase costs. However, the lawmakers are now discussing a compromise that could reduce those requirements and lower the bank's capital burden by billions of dollars. Now, the proposals come as Switzerland seeks to strengthen financial safeguards following the collapse of Credit Suisse in 2023, while also preserving UBS's competitiveness in global markets. Now, the shares of UBS, they rose about 2% earlier today on that news. That's global news for Tuesday. I'll see you tomorrow.
All right, thank you so much, Anita. Well, right here, we're seeing markets already buzzing this morning, and it's a wet trading day today. We see the NGX there. Looking at the terminal on investing.com, we're seeing a pullback there, about 0.28% lower. Stocks getting attention. We have the likes of Sterling Bank, Abbey Mortgage Bank, FCMB, United Capital, mostly financial services getting attention this morning. Those are the most actively traded stocks right there on the NGX. Then you flip over to the global market, we're still seeing oil prices in the red. But this time, we're not seeing gold in the green, even though oil is down. We're seeing gold also down this morning, following what we saw yesterday. Bitcoin, that was getting a recovery yesterday, but now we're seeing a pullback for Bitcoin already, profit taking with, bears already, taking profit with a little profit we saw there with the price, after falling below the $60,000 level. So it's 1.26% lower. Ethereum, that's also struggling, $1,670 per coin, down 0.96%. Solana, a big drop, about 2.03%. And meme coins, Dogecoin and the rest also down this morning. So we see investors looking for direction there in most of this market. Are they pulling out mostly for the upcoming IPOs? So much to unpack there. We also have the first meeting there with the U.S. Fed there on the wash at this point, post Jerome Powell. We have a new sheriff in town there when it comes to the U.S. Fed. So a lot for investors to look out for. But watch the shows. What Business Incorporated at 1:30 to get more updates. I'm Ladi Williams from here, the team right here at Channels HQ. Bye for now.